there! Ready for a wellness adventure? Let's explore the world of health together.
Ever wondered why your friend in another country has a totally different experience with healthcare than you do? It's not just about the doctors or hospitals. It's about the entire system behind them. Let's break down the world of health insurance, and I promise, by the end of this, you'll see healthcare in a whole new light. Globally, health insurance systems fall into three main categories: public, private, or a mix of both. Think of it like this. A public system is run by the government, a private one is run by companies, and a mixed system is, well, a hybrid. The choice a country makes reveals a lot about its values and priorities. Let's start with the public framework. This is the model where the government takes the lead. How does it work? It's funded primarily through taxes. That could be income tax, payroll tax, or other national contributions. All that money gets pulled into a central fund, which then pays for healthcare services for everyone who is eligible. Government health departments are in charge of everything from signing people up to deciding what services are covered and paying the doctors and hospitals. The big idea behind public systems is usually universal access. The goal is to make sure that getting sick doesn't mean going broke. Your access to care is based on being a resident or a citizen, not on your job or how much you earn. It's built on the principle that essential healthcare is a public responsibility, something everyone should have a right to. This means coverage is standardized, so pretty much everyone gets the same core benefits package. Now, let's flip the coin and look at the private framework. Here, insurance is a contract between you or your employer and a private insurance company. You pay a monthly fee, called a premium, and in return, the insurer agrees to pay for your covered medical bills. While these are private companies, they don't have free rein. The government still sets rules to protect consumers and ensure the system is stable. One of the biggest differences you'll notice is choice. Private systems often offer a wide variety of plans. You can pick one with lower premiums but a higher deductible, or a pricier plan that covers more services with a wider network of doctors. This flexibility is a key feature, but it also means you have to do your homework to understand what you're actually buying. So, how do these two systems manage their money? Public systems depend on tax revenue, which can go up or down with the economy. Private systems rely on premiums, which they adjust each year based on how much they expect to spend on healthcare. Both have the constant challenge of balancing the money coming in with the money going out to stay afloat. Another key difference is how they pay doctors and hospitals. In a public systems, the government often sets standard payment rates for everyone. Imagine a national price list for medical procedures. This can simplify things and help control costs. In a private system, each insurance company negotiates its own rates with different hospitals and clinics. This can lead to a lot of variation in what a procedure costs, depending on your insurance and where you go. What about getting signed up? Eligibility is another dividing line. Public systems usually define eligibility through things like residency status, age, or income. For example, you might be covered simply because you've lived in the country for a certain amount of time. Private systems determine eligibility based on your enrollment agreement. In the past, they could sometimes deny coverage for pre-existing conditions. But thankfully, many countries now have laws that prevent this, pushing private systems to be more inclusive. Then there's the paperwork. A public system, especially a single-payer one where the government is the only insurer, can streamline administration. One set of rules, one place to submit claims. Private systems, with many different insurance companies, create what's called a multi-payer system. This can mean more administrative complexity, as doctors' offices have to deal with dozens of different insurance plans, each with its own rules and billing procedures. How do they keep costs from spiraling out of control? Both have their own strategies. Public systems might use global budgets for hospitals, basically giving them a fixed amount of money to run on for the year. They also use their massive bargaining power to negotiate lower prices for drugs and medical equipment. Private systems often use managed care techniques. This includes things like requiring you to get a referral to see a specialist, needing prior authorization for certain treatments, or having tiered drug lists where you pay less for generic medications. Of course, in the real world, things are rarely so black and white. Most countries use a mixed model, blending elements from both public and private frameworks. A common approach is to have a public system that covers all the essential, basic care for everyone. Then, people who want more can buy private supplemental insurance to cover things like dental, vision, or a private hospital room. Another mixed model might have the government providing coverage for specific groups, like seniors or low-income families, while the rest of the population gets private insurance through their jobs. These hybrid systems are an attempt to get the best of both worlds, the fairness and equity of a public system with the choice and competition of a private one. Let's talk about changing jobs. In a public system tied to residency, your insurance usually stays with you no matter where you work within the country. It's portable. With private insurance that's tied to your employer, losing or changing your job can mean losing your coverage. Many countries have regulations to help people keep their insurance during these transitions, but it can still be a major source of stress. Ultimately, it comes down to philosophy. Public insurance is often built on the idea that healthcare is a social good that we are all responsible for, together. Private insurance is rooted in the idea of a contractual agreement, managed through market competition. But as we've seen, most modern systems are a pragmatic blend of both. Understanding these structures isn't just academic. It helps you make sense of your own coverage, why the rules are the way they are, and how to navigate the system you're in. Neither system is inherently better. They're just different ways of tackling the same huge challenge. Spreading the financial risk of getting sick across a large group of people in a sustainable way. And that, at its core, is what health insurance is all about. Ever wondered how most people get their health insurance? For millions, the answer isn't a government program or buying a plan on their own. Instead, it's through their job. This is called employer-sponsored insurance, and it's a huge piece of the healthcare puzzle in many countries. Today, we're going to break down exactly what it is, how it works, and why it became so common. Let's dive in. So, what is employer-sponsored insurance? At its core, it's a system where your employer offers you health coverage as part of your job benefits. Instead of you going out and shopping for a plan, your company does the legwork. They partner with insurance companies, select a few plan options, and then offer them to you and your colleagues. This whole setup didn't just appear overnight. Historically, it grew as a way for companies to offer valuable non-wage benefits to attract and keep good workers, especially during times when wage increases were limited. Over time, it just stuck, becoming the primary way many people access healthcare, especially in countries with strong private insurance markets. Let's look at the mechanics. It all starts with your employer making a deal with an insurance company. They negotiate things like the types of plans available, how much you'll pay out of pocket, and the monthly cost, which is called the premium. Here is a key advantage. The insurance company does price your plan based on your personal health history. Instead, they look at the entire group of employees as a whole. This is called group-based pricing. By spreading the risk across a large group of people, some healthier, some not, the average cost per person usually ends up being lower than if you were to buy a plan by yourself on the open market. It's the power of numbers. Now, let's talk about who pays for it. It's typically a team effort. Your employer usually covers a significant portion of the monthly premium, and you pay the rest. Your share is automatically taken out of your paycheck, which is why it's called a payroll deduction. What's interesting is that the part your employer pays is still considered part of your total compensation, even though you never see it as cash in your bank account. This cost-sharing model is designed to make insurance more affordable for the employee while keeping the whole system funded. It's a win-win that reduces the sticker shock of healthcare costs. You can't just sign up whenever you want, though. There's a specific window of time each year called open enrollment. This is your chance to review the plans your employer offers, compare the benefits and costs, and decide if you want to enroll or make changes to your current plan. Employers are required to give you standardized information to help you make an informed choice. If you miss this window, you usually have to wait until next year. Unless you experience what's known as a qualifying life event, things like getting married, having a baby, or losing other health coverage. These events give you a special opportunity to enroll or change your plan outside the normal schedule. And it's not just for you. Employer-sponsored plans often extend coverage to your family, or what the industry calls dependents. This usually includes your spouse and children up to a certain age. Of course, Adding family members will increase the total premium, but it's an essential feature for ensuring your loved ones have access to care. In fact, many public health regulations set minimum standards for dependent coverage to promote family health stability. By including dependents, the insurance pool gets even bigger, which further helps in spreading the risk. So, who's actually running the show? Your employer is the plan sponsor, but they don't typically handle the nitty-gritty of medical claims. That's the job of the insurance company or a specialized company called a third-party administrator. They're the ones who process your claims, negotiate with doctors and hospitals, and handle payments. Government regulations make sure employers are transparent about how the plan is managed. Now, there are two main ways employers can structure this. One is a fully insured plan, where the insurance company takes on all the financial risks for claims. The other is a self-funded plan, where the employer pays the medical bills directly from their own funds, using the insurer mainly for administrative tasks. The type of plan you have can affect how benefits are structured and how any disputes are handled. Taxes also play a huge role in making this system work. In many places, the money your employer contributes toward your health insurance premium is not considered taxable income for you. This is a deliberate policy choice by governments to encourage companies to offer health benefits. This tax advantage is a major reason why employer-sponsored insurance has remained so popular and is a central pillar of the healthcare system in certain countries. It's a powerful financial incentive for both employers and employees. When you use your insurance, you'll encounter provider networks. Insurers create these networks by making agreements with specific doctors, hospitals, and clinics. Using providers in network almost always means you'll pay less If you go out of network, your costs will be higher. To help you plan, employers are required to be clear about which providers are in the network before you even sign up. Alongside networks, you'll also see terms like deductibles, copayments, and coinsurance. These are all forms of cost sharing, defining how much you pay versus how much the insurer pays when you get medical care. To protect you from runaway costs, regulators often set an annual limit on your total out-of-pocket expenses. But what happens if you leave your job? Since your insurance is tied to your employment, losing your job can mean losing your coverage. This is a major structural issue. To bridge this gap, governments have created rules for continuation coverage, like COBRA in the United States. These laws allow you to temporarily keep your employer's health plan after you leave, but there's a catch. You usually have to pay the entire premium yourself, including the portion your employer used to cover. It's expensive, but it can be a lifesaver during a job transition. One potential downside is limited choice. Unlike an individual marketplace where you can browse dozens of plans from different companies, your employer typically presents you with just a few pre-selected options. This simplifies things for everyone, but it does reduce your flexibility as a consumer. The choices you have are the choices your employer has made for the entire company. Finally, the health and age of your entire workplace matters. A company with a mostly young, healthy workforce will likely have lower overall healthcare costs, which can lead to lower premiums for everyone. On the other hand, an older workforce or one with more chronic health conditions might see higher premiums. Insurers constantly analyze this group data to set prices for the next year, always under the watchful eye of regulators who ensure the process is fair and not discriminatory. In the end, employer-sponsored insurance is a complex partnership. It links your healthcare directly to your job, spreads financial risk across employee groups, and weaves health benefits right into your compensation package. It's a private insurance model, but it's heavily shaped by public regulations and tax policies. It's a unique system with its own set of pros and cons, but it remains the bedrock of health coverage for a vast number of people.
Thanks for watching. Hope you liked it.